And I just want to say how pleased I am that in just a few minutes' time at the end of the last panel, we were able to build a broad-based, comprehensive consensus on the very thorny issue of carried interest taxation. That was that was very, very pleasing to me personally. I'm very, very honored to introduce our keynote speakers for the lunch. I'm here merely to moderate, introduce and moderate. We thought a lot in the weeks leading up to putting on the conference, what sort of keynote would we want? We came up with the idea of a conversation on the same panel, having had one panel of panelists mostly from the LP side, another panel from the GP side. We wanted to put LPs and GPs together on the same panel, and we were very, very pleased when we were able to get two very fine practitioners, very experienced people on both sides of the ledger. We're joined here by Vikas Garg, who's a portfolio manager for CalPERS, and Christopher Kiper, who's managing director of Legion Partners Asset Management, LLC. In keeping with our theme of A View from California, both are based here in California. Chris here in Southern California, Vikas in our great state capital, Sacramento. So what I want to do to start off is I want to give each of them an opportunity to give an introduction of themselves, both kind of a personal biography and where they are now in their careers, and give some background color on that. And then we've got several, I think, quite interesting topics. We had a vibrant conversation at the end of the last panel. Hopefully this will be equally vibrant here. As opposed to before, I would ask you to keep your questions until the end so we can really work as much as we can to develop the conversation here between Vikas and Chris. But we will be having Q&A at the end of the session. You can ask them questions, anyone else who's here who was on any of our other panels as well. So let's kick off with you, Vikas.
So hi, I'm Vikas Garg from CalPERS, which is the California Public Employees Retirement System. We manage roughly $290 billion in our investment office, and our investment office really serves to carry out the investment activities on behalf of the state and the state's retirees. We manage money for 1.6 million public employees and retirees of the state of California, and really a large part of what we do is not only manage that money, but manage it to the extent where we provide health and retirement benefits for those retirees.
Chris?
Yeah, sure. Chris Kiper. I've been an activist investor for 15 years for two different family offices prior to founding and launching Legion Partners. Most recently, I worked for the Disney family at a firm called Shamrock, where I was the portfolio manager on a $1 billion activist fund focused on Russell 2000 companies. My interest in activism really stemmed out of not being very successful as a private equity investor early on. The first family I worked for, we tried to do several private equity investments. The family had a real desire to go out and buy a business that they would then control and run. And we went to private equity auction after private equity auction, and ultimately were just never the winning bidder. And on the heels of that experience, we went out and we started looking around at the public markets, and what we found were there were better companies than what we were bidding on in the private equity process, trading at lower multiples, and oftentimes the numbers had no adjustments, right? The private equity business plans that we saw always had tons of seller adjustments. You look at the guy's tax return, he made no money, but the business was magically profitable in the books that we got. So really started to focus in on small cap and micro cap companies, and really taking on a big stake in those businesses and then pushing them for the right outcome. 4 years ago, I left the Shamrock organization and left with my partner, Brad, and we set out to form our own fund. And it was a tough time to go out and try and launch a new fund. It was 2010. It was very difficult to raise money. Activism was really not in vogue at all at the time. We spent over 4 years getting to the point where we finally got seated by CalSTRS, the California State Teachers Retirement System, earlier this year, and they put in a $200 million commitment to our fund. They gave us a 5-year lockup on the money. So we have a very long-term time horizon where we know we'll be successful when we go in and we interact with companies. But that process took an awfully long time. And the thing that I would say from a new fund perspective that's really important is being entrepreneurial about your approach. From day one, we sort of thought we could launch a fund. It would be pretty easy. We found that the fundraising process was very difficult. And so what we did, we woke up and we said, look, what we really need to do is let's go back and retrench around the things that we're really good at. And that was research and finding attractive companies. And so what we began to do was to write research on companies that we came across. Typically when we wrote research, it was 60 to 80 pages worth of documentation on our ideas. And we went out and we tried to find investors for these ideas. And over the course of a few years, we found 3 different investors who ponied up $350 million for our ideas. And we wrote on 13 different companies. And just to give you a sense, we got 3 of those deals funded. So our hit rate wasn't nearly perfect. But what we were able to do was to generate some pretty amazing returns. So in the case of the 2 investments out of the 3 that we've exited, we put $200 million to work. We earned those investors $80 million on their money in just under 6 months. Both the investments had about the same time horizon. The 3rd investment we're still underway on. It's a company that my partner and I have been invested in for 3 years. Ticker symbol is RCMT. It's a staffing and services business. We ran a proxy fight at that company last year. We generally don't like to run proxy fights. We'd like to resolve our differences with the board and the management team through what we term quiet diplomacy. But where that's not possible, we will seek to exert our rights as shareholders. We talked a little bit about earlier the benefits of being in California. I would say that we would echo many of the things we heard on the earlier panel. The weather here is amazing, obviously. It's hard to get people to leave once they've been here for a while. We really enjoy not being in the New York groupthink. I find when I go to New York, I hear the same people talking about the same deals. They all have the same perspective. And I think oftentimes they think that the other guy must have done research, so they don't really need to do as much. I'm really happy to be out of that. We found that there are a vibrant set of folks that we can go and hire as employees that want to be in Los Angeles for one reason or another. Oftentimes family, oftentimes they can't leave. And the equity market here in Los Angeles in terms of investors is really not that big. There's not that many equity-focused funds in Los Angeles. And so once you get somebody here that you really like, there's not a lot of choices in terms of other places for them to go. In terms of negatives, obviously there's a 3-hour time change between here and New York, and we are very much in a New York business. And then the tax rates, as we've talked about, maybe a little bit too much, are rather high here.
First thing I want to do to kick off the discussion, and we'll lead with Vikas, is seeding new managers. We got a brief glimpse at the Legion story, recently launched and already quite active. Let's start with you, Vikas. What's your view on seeding new managers, the types of managers that you're most interested in, that CalPERS is prioritizing? What can you say about that kind of general process of picking the big star for 2-3 years down the line?
Sure. So maybe I'll start by giving you guys a sense of what we do at CalPERS. I mean, we have investments in more than 1,100 external managers, and that's a big number. That's about $84 billion of the 290 is invested in external managers. And then if you look at the number of managers that fall under our definition of emerging managers, it's about 400 of those 1,100, and that's $12 billion in assets. So it's definitely a big number. And I think as you pointed out, Tim, I mean, one of the objectives is definitely to find people early on and build relationships with them so you have the opportunity to invest with them, build that sort of next generation of talent. That's important when you have long-term liabilities like somebody like CalPERS. You really need to have a plan for sort of executing, building your investments. It takes time because everything that we do is through structures, highly structured structures. For example, on the hedge fund side, it takes us 6 months to open up separately managed accounts with our underlying managers. And somebody on one of the other panels pointed out, gross negligence versus negligence. These are debates that we have with our managers, and not everybody makes it through. So there's definitely that aspect of sort of finding new talent and seeding them. But I think first and foremost, it's about performance. There's definitely been a lot of research that's come out recently. There's been a couple of books about the value add of emerging managers, smaller managers generally outperforming bigger managers. I think some of that is due to the concentration in the assets that you'll find in smaller managers. Startups will tend to be more concentrated, and as they grow, they'll become more diversified. That's both in their underlying investments as well as sort of just the diversity of the assets that they have. CalPERS' experience, I think, at least I can speak for the hedge funds, hasn't been one where the performance of emerging managers has been better than our established managers. In fact, our established managers have outperformed our emerging managers. And I think part of that is just, while it's all about the performance and what they're investing in, you're taking a lot of additional risks investing in emerging managers. You're also, there's operational risks, there's legal risks, there's reputational risks. There's the risk that the manager doesn't raise any other money. So then you've got, not only do you have a problem that you have seeded somebody or invested in them early, but now you've got a psychological or a behavioral complexity that you've added where you're the only LP or you're the largest LP, and you can literally put this guy or a person into business or out of business. And that's also a tough call to make when you're an investor. So I think for CalPERS, while we are committed to emerging managers, there's a big component of California-based managers in our emerging managers mandate. There's a big component of diversity managers, and to the extent if anyone's interested, I can elaborate on that. But the experience has definitely been mixed, but CalPERS has been committed.
Chris, your experience.
Yeah, sure. So after going through the seeding process, I would say it's extremely difficult. You can go find a list of people who appear to be seeders on the internet. There's plenty of them. The list will look like there's 50 different firms that are actively doing this. What we found is there's a lot of them that actually don't have any capacity at all. Some of them don't even exist anymore. They've gone out of business. The other problem that we saw was there were certain firms who were very much open to seeding new managers, open to activism, which was our strategy, but they had just recently done an active manager who was an activist, and they didn't want to seed another one right on top of that, because the way that those seeders work to help those firms raise money once they've gotten started is to go out and talk to a limited partner base that they know well. And if they've already taken a product out that looks a lot like you, they're probably unwilling to do it again. I also found that in the seeding community, there tended to be a lot of focus on pedigree. What schools did you go to? If there were certain schools that these folks were looking for that you went to, great. If you didn't happen to go to those schools, it was a little bit more difficult. One of the other big problems for somebody who's launching their own firm is track record. It's very difficult, oftentimes, unless you're leaving a firm with your entire team, to take the track record and really claim it as your own. It's certainly not GIPS compliant unless all the members of that team went with you, and oftentimes that's not the case. And so it's often even difficult to represent what your track record is. The other part that's been talked about here plenty today is just all the regulatory hurdles with getting set up and launching a new fund. There's a ton of them. They're getting more difficult. We've outsourced a lot of that stuff. We have a chief compliance officer, but we've tried to outsource as much of that as we possibly can. We have people that go through our individual personal accounts, looking at what stocks we're trading every month to make sure that they don't conflict with what the firm's doing. There's people who are going through emails to go and see what marketing information is being sent out to people that we're emailing with. There's just a tremendous amount of review and oversight that goes on, and it's obviously a big burden to comply with all that. So, I think getting seated by the right person, where you have the money that it's going to take to actually get the systems up and in place that you need to be effective, and to do it the right way is really important.
Vikas, any further thoughts?
Yeah, to that extent, I mean, I think the pension community and our role as seeders is very important. And to the extent where we can make long-term investments, it's good because, you know, you need that capital, but you need that capital not just for a year. You need it to be sort of stable, right? So given our liability structure and what we're trying to achieve, which is hit our actuarial target of 7.5%, seeding can make sense. Now, where I think be interesting to have a conversation is, to what extent do we get involved? Do we act just as LPs, where we're making an investment and we're getting our hopefully a capital appreciation on our capital, or do we have revenue shares? Do we take an equity stake in the business? If we do that, how do we monetize that? Those are all issues that we also discuss and grapple with at CalPERS.
And is it safe to assume that sometimes the answer is yes?
We have taken revenue shares on the hedge fund side. In private equity, we had equity both in Carlyle and Apollo in the past, and it's something that we look at. From a cost of capital perspective, I used to work at an investment bank, so things like cost of capital and risk-weighted assets and Tier 1 capital were very near and dear to me, and from that perspective, CalPERS doesn't have those same issues, so we can be long-term providers of capital for the right manager.
Chris, Vikas is talking about economic layers on top of the underlying relationship. How about know-how, support, introductions, the softer value add? Do you look to a seeder to help you solve a wide range of day-to-day problems, or it's really just about the numbers on the spreadsheet? What are you getting and what are you giving?
I think we get from CalSTRS a lot of help, especially in terms of lining up other institutional support behind things that we're trying to do, whether that's fundraising or whether that's trying to actually go out and get votes for some activity that we have at a company. They're very effective. They're out there and really good partners in that regard. They're also extremely happy to give us references to anybody who wants to call up and talk about what we do. But they're economic owners at the end of the day of the GP, so it's in their best interest to do that as well. I think that if you got funded by a more traditional hedge fund, you'd probably see a little bit more of that hedge fund's marketing department. The CalSTRS and CalPERS of the world don't really have a marketing department to go to help the funds that they're seeding go out and raise capital. But I think some of the more traditional hedge funds, I know people that have gotten seeded by them, and that's really a big push inside those organizations.
A very big topic with public pension plans, something that I think California was a driver on, are the so-called ESG guidelines, ESG issues, environmental, social, governance, doing well while doing good, I guess is one way to look at it. Let's start with you, Vikas. How important is that to the CalPERS investment approach, and particularly either among seeding decisions that you're making or generally, how do you integrate the economic decisions of who to back and how much to back them for with your ESG policies?
So we have a lot of ESG policies. So CalPERS, a couple of years ago, instituted what they call investment beliefs, and maybe it'll be helpful to go through sort of our governance structure. I mean, we have an internal investment strategies group, which is kind of our internal investment committee, but then that all reports up into an investment committee and board, which is comprised of various different California stakeholders. So it's a mix of elected and appointed officials from the state, from the governor's office, from the treasurer's office, and from various different California workers contingencies. So constituents, you might have postal workers and firefighters and police officers that serve on our board. So ESG is really important because while I work in the investment office, the real crux, the real benefit that our state workers receive from CalPERS is not just retirement income, but also health benefits, right? And so when you think of environmental issues or social issues, governance issues, or even socially responsible investing, these are things that our stakeholders care about. So CalPERS has been, so we have in our investment beliefs, we have ESG and socially responsible investing as sort of key tenets as part of our investment beliefs. And we have, we're a signatory to the UN principles on responsible investing. We take it a step further. I'm actually on a committee internally that is looking at how we can best implement ESG initiatives. So we monitor right now, we catalog what our external managers are doing in the ESG space. We catalog, and to the extent that CalPERS internally has ESG efforts, we catalog that, but how do we really incorporate those into our investment process? We've done some of that. I'll give you an example. We've divested recently, we've been divesting out of tobacco-related companies, and we've been advocating companies like CVS and gas stations and pharmacies to stop selling cigarettes and tobacco. And there's other issues, whether it's gaming, whether it's alcohol, whether it's firearms. And so CalPERS has been a proponent of ESG-related efforts in these various different areas. And it's a debate. I think it's a debate worth having internally in our investment staff. It's the question I always ask is, well, these are all things that are legal in the state of California. Any of us can, after lunch, go and smoke a cigarette or drink or gamble or whatever. And so why are we divesting in these things? And I thought it was an interesting statistic. There's not a lot of indices. There's a lot of indices that track the performance of markets if you strip out all of these bad things. There's nobody that says, well, what if you just have an index of these things? But there is a mutual fund in Chicago called the Vice Fund. You guys may have heard of it, but I looked at the performance of our global equity benchmark over the last 10 years, and I looked at the performance of this mutual fund. And this mutual fund is picking stocks, so it's different than investing in an index. But over 10 years, if you had invested in this mutual fund, you would have outperformed our global equity benchmark by 4.8% on an annual basis. So that's a lot of money, right? Now I'm not advocating. This is being recorded.
Let's make this clear.
Yeah, I'm not advocating. I'm not advocating diverging from what our policies are, and I think these are important, especially to the extent where, again, we have health benefits. We're paying for health benefits. That's where the investment income is going. But I think it's a relevant question, maybe out of all of this, to ask, what's more harmful, tobacco or sugar? You can have that debate.
And just to ask, not that I have any personal interest at all, where do you stand on something that's an emerging vice, like marijuana legalization?
Vaping.
Or vaping, which obviously your policies won't cover vaping or marijuana. I was at a conference in New York, an agricultural fund conference, and of course there are two. There are two funds looking at the legal monetization of marijuana. Is that, how do you deal with all these new vices being created?
I don't have a good answer for that. I think it's a debate. I think these are game changers. Are these going to be incorporated? It's interesting that we talk about firearms so much and divesting from firearms companies. I came from New York City. Nobody has a gun in New York, and in Northern California, in Sacramento, a lot of people have guns, like 10 guns. So. These are all, and that goes back to the point. These are not illegal activities.
Right.
So.
And so turn it to Chris. Chris, you're sitting there, you're doing your research, you've got your team finding these great investment opportunities. All of a sudden you realize you're tripping up against an ESG prohibition. How do you integrate those requirements that are being put down to you from an anchor tenant investor? How do you integrate that into the opportunities you do, what you do for the fund, what you do outside of the fund, your fund?
Yeah, sure. So on the ESG front, on the social aspects of that and the environmental, there are certain things that CalSTRS has asked us not to invest in. Firearms would be one of those, and tobacco is another one. I think if you go back, it's back to the point that you made earlier, and look at the performance that they've missed out by not being in some of these things. There's a lot of performance that's been missed by not being in some of these investments. And so there's a question there. And then there's a question related to that. I mean, it's the convenience store, the gas station that generates a lot of its income from the sale of cigarettes. It's the sporting goods store that generates a lot of its income from the sale of firearms. Should we not invest in sporting goods stores? And so there's a lot of tangential questions like that. If you look at the pure number of companies that are excluded from the index, though, for being a tobacco or a firearm-related company, there's really not that many of them. So it's pretty easy to avoid those generally. What we do, though, is governance. The G in the ESG is a huge issue for us. We spend a lot of time on corporate governance, and I would sort of break it down into two areas. Governance structures at the company themselves, and then compensation, because they're really two different things, but they both get back to how the company is governed. So on the governance front, we're looking for every company that we invest in to de-stagger their board, so all the directors have to stand for annual election, implement majority voting, so if the directors don't get a majority of the shareholders voting for them, they leave the board. The old standard used to be if just one guy voted for you, you got to keep your board seat, which seems a little odd. Separating the chairman and CEO role, that is happening more and more at companies. We really believe that it's important, though. The guy setting the agenda for what's discussed at the board should not be the operator of the business. You generally don't get a very fulsome debate and a real look at the issues if the guy operating the business is setting the agenda at the board level. We like to get rid of poison pills wherever we can. We think poison pills have a limited place to help a company defend against a hostile takeover bid, or to give them an opportunity to find more bids if just one bid has surfaced and it's got a short time fuse on it. But generally would like to see companies get rid of poison pills. And then the ability for shareholders to call a special meeting. The annual meeting happens obviously every year, but there should be an opportunity for shareholders to get together and talk about things if topics need to be discussed between annual meetings. And oftentimes companies have a very high hurdle where shareholders can't call a meeting and take on that business. In terms of compensation, the other big area that we focus on, we really want to make sure that the way that the executives are getting paid at the companies that we invest in align with how shareholders make money. And oftentimes that's not the case. I can't tell you how many broken companies we've looked at where the real source of the problem at the end of the day was the compensation plan, that we had incentivized the owners to do things that didn't make any sense. And we've just seen it time and time again. And a rant about compensation, though, is not to say that we don't want to see people paid well. We'd like to see people paid very well for good performance. It just needs to be good performance that the shareholders got something out of. In terms of the impacts of the governance-related changes, they're very massive in the market. And if you think about it from my investors' perspective, and when I was at Shamrock and at Legion Partners now, we invest for large public pension funds. That's the lion's share of where our capital comes from. These investors are going to be invested in the U.S. markets for decades. They have a very long-term time horizon. And what they're looking for are folks like us to go on and take on companies and make a difference in the structures that are out there. And so if you go out and you look at majority voting, and I got the statistic here, if you go back to 2005, there were 0 Russell 3000 companies that had majority voting. Nobody had it. Today, 35% of those companies have it. So 1,000 companies have implemented majority voting. And staggered boards, if you go back, the S&P 500, not very long ago, 2002, 60% of the boards in the S&P 500 were staggered. Most directors were then elected to a 3-year term. About a third of the directors stood for election every year. And it was a great system to make sure that the board couldn't all be voted out at once. If you look at it today, that's really changed. There's only 12% of the S&P 500 boards that are still staggered. And there's more and more of those going away every day because shareholders really want to see the directors of the companies that they've invested in become accountable for what's going on at the company. And it's really important, and it's something that we focus on with every single company that we engage with. And we'll have a discussion behind the scenes with the company, and if we can't make progress on these topics, and oftentimes we can because the company realizes if these things make their way onto a ballot, guess what's going to happen? ISS is going to recommend for it. The shareholders are all going to vote for it, and this is going to pass very easily. And so why don't they just take action on their own? And they often do.
Vikas, governance. You talked a lot about social. What's your views at CalPERS on governance?
I mean, governance is obviously a key factor. So CalPERS up until about 3 years ago had a focus list, and that focus list was basically companies that were bad companies, companies where there was broken corporate governance, and CalPERS would actually put these names, publish them on their website, I think on a semi-annual basis, update these lists. So we've sort of shifted from that approach to being less public and more sort of behind the scenes and sensitive to the companies. So there is a governance approach. The way that Ann Simpson, who's our head of governance, does it is basically we filter using the top 1,000 U.S. companies with a market cap of more than $2 billion, and then basically filter these companies through a variety of performance factors and fundamental factors, and governance factors, and governance factors. But basically, thank you. I mean, basically, the idea there is to work and actively engage the companies in governance. One of the things that we have is we have $160 billion invested in public equities, so we can be a meaningful shareholder and act towards board resolutions. We can work with, to the extent where we have activist managers, or to the extent that where we have relationships with external managers, we can actually work with them on shareholder resolutions and proxy voting and things like that. So we're quite active.
And in many ways, Chris, just as a closing thought, an activist investor, an activist fund is particularly well suited to take on governance issues.
Oh, no, definitely. I think it's the bread and butter of what we do. I think the one thing that we hear from some investors are it's very difficult to go back and look at governance moves on their own and tie that back to increasing shareholder value. It's very difficult. There's been a lot of studies done on this. And for every study that says that it works, I think there's other studies that say that it doesn't work. What I can tell you is upping the level of accountability is always a good thing in the system. And it's often really difficult to tie that improvement, if you will, back to shareholder gains. But we know by taking on these governance issues and making these companies more accountable, we are setting up the next generation of shareholders of these same businesses, if they continue to exist, to be in a much better place than folks are today.
Yeah, Chris, you mentioned you have a 5-year lockup with CalSTRS. So I think with respect to activists, and one point that I didn't touch on, investing in external managers, I think an investor has to be really careful because it's hard to get. You can't get the timing right when it comes to investing externally. You might be in a situation. It might take 6 months for it to work out. It might take 2 years for it to work out, and in the meantime, depending on what your objectives are as an investor and where those investments in activist managers sit, right, you may need to pull out your capital, right? Or you might need to allocate that to another manager or allocate it to another strategy. And so timing, it's really, really hard to get the timing right. And so you need to be long-term. I think, if you're going to invest in activist managers, you've got to think about it as a 5-year strategy or a 10-year strategy, and really think about who you're going to put that capital to work with. I think that's where recently we've been seeing a lot of hedge fund investors getting into activists, and I think there are a lot of these guys, especially the fund of funds, right? When they get that redemption notice from their LP and they need to pull the capital, they're going to find that their experience investing in the activist manager might not have been so great. And I'll tell you why. Because, you're taking a dog of a company, right? And you're saying, okay, we're going to work with this company and we're going to, create enhanced shareholder value. So fine. So maybe that takes 2 years and maybe the company goes up 50%. But what if, as an investor, in the meantime, you've left a lot of really cheap or free beta off the table? What if the relevant S&P sector index during that same period is up 100%? Now, there's two ways to look at it, right? You can say, on an absolute basis, my investment's up 50%. It's wonderful, right? Or can you say, on a relative basis, I underperformed by 50%? Right. So I think those are important questions to ask when you think of, at least from my perspective, when I think of activists. And I've seen it. I've looked at a number of managers that have been raising a lot of money in the space recently, guys who are in the headlines. And when you peel back the layers and you actually compare, you look at sort of how those companies performed and how you would have performed have you just invested in the S&P sector ETF. You'd be quite surprised. And because we can do some things so inexpensively at CalPERS internally, we manage our internal equity book at 1 to 2 basis points, right? So, if Ann wants to invest in a corporate governance situation, it's very inexpensive for us to do it. The value add from an activist manager, from an external manager, has to be really, really great.
And part of that value add is obviously going to be the amount of return they generate net of fees. We've talked a lot about fees today, and we'll continue to talk about fees a lot now. Let me go back to you straight away, Vikas. Management fees, performance fees. We heard a lot of really great insight from the first panel about different views that they have on management fees and performance fees. Can you give us your view, CalPERS' view generally, and any interesting trends or directions you think fees are going overall?
Yeah, so I think if you look at our external manager investments, we have about $84 billion invested in external managers. And in the last fiscal year, the last calendar year, 2013, we spent $1.2 billion in external manager fees. That $1.2 billion, the large bulk of that was private equity fees, right? So for about $440 million of that was private equity manager management fees. That $1.2 billion doesn't include the carry that CalPERS pays on its private equity investments. So I don't have a number for you for that, but we don't calculate that right now internally. So that's a lot of money. Now, if you're a California state worker and you have a retirement account with CalPERS, you might be thinking that's a lot of money. Now, our investment office, the budget for our investment office, all the staff compensation, our Bloomberg's, everything last year was $40 million. What the Canadians, ADIA, Temasek, GIC, what some of the world's largest sovereign wealth funds and big institutional investors like us have been doing is bringing in investment talent wherever they can to manage a lot of the investments internally. You can run private equity internally. The Canadians have done it really well. So what if I said to you, the state worker, we could lower that $1.2 billion by 20%, by 30% over the next 5 years, right? If we increased the staff, the budget for the investment office from 40 to 80 or 40 to $100 million, would that seem like a very reasonable and good thing to do? I think so, because you're going to have $100, $200, $300 million in cost savings. That is achievable. It's been done by other big institutions. But because we're in the state of California and because we have these stakeholder issues and because people can go online and see how much public employees make, and because people, public workers are reticent about how much people at CalPERS already make, that'll never happen. And so it's a bit of a shooting yourself in the foot type of thing, because ultimately it's your money. This is not being paid by taxes, it's being paid by your retirement, what you're putting into your retirement.
Because when that 40 million is doubled to 80 million, basically, there's a lot of ways to spend $40 million, but hiring 40 people at $1 million a year is a mathematically simple way of doing it. And there's a political blowback from that, is what you're saying? Is that seeing on the website someone taking home $1 million, $2 million, $3 million a year is not digestible?
Yeah, no, I think that's not justifiable for a lot of people. But again, it begs the question: you're spending all of this money. It's not like you're not spending it. You spent $1.2 billion last year, so it's really a question of what that net figure is. If we can reduce that net figure by moving things around, wouldn't you want to do that? That's one thing. I mean, I would say that's kind of that's how I think about it from CalPERS perspective. I mean, with respect to manager fees, I think it's a dialogue, right? I mean, we pay premium fees, we pay discounted fees. We have our benchmark on the hedge fund side is 1-year treasuries plus 500 basis points. Whatever direction the market goes, that's what we need to make in order to get paid. And so we structure a lot of our hedge fund manager fees with hurdle rates or with prefs, and that's not something that's really commonly done, but we push on our managers and we say, look, we'll pay you a higher performance fee for higher performance. Obviously, you need to act within your investment guidelines, so you can't take more directionality, more gross exposure, more net exposure, but if you can manage your strategy and do what you actually say in your pitch book, right, which is, I target a 15% return per annum, right? Well, if you get us there, I'm happy to pay your performance fee, right? Full freight. But if you can't, we're not going to pay you a performance fee at all. And so a lot of the stuff, whether it's if you get me to a 14% return and it's 100 basis points, you're not getting a performance fee. So, and we'll structure these mandates with a very long term. So 3-year crystallization on the performance fee, and that's kind of what we think in terms of alignment of interests.
And how, as a startup fund manager in the early days of your business cycle for Legion, how do you respond to these pressures now? Because they're almost disproportionately felt by the new startup manager who doesn't have billions of dollars of assets out there.
Yeah, so we actually have tried to turn it around to be a competitive advantage for our fund. What we've done is we've basically agreed with our investors that we'd like to try and run our management company at cost. So that doesn't turn into a profit center. I think the thing that we've heard time and time again from large funds and large public pension funds are, the management fee makes sense at some smaller level, but by the time that you get a manager who's approaching, call it $6 or $7 billion of funds under management, he's getting paid a 2% fee on that. He's got 40 people in his office. It's not real hard to see how that guy's turned that management fee into a profit center. $140 million management fee on $7 billion easily funds his operation, and there's quite a bit left over at the end of the year, I guarantee you. And so what we've said to our investors is we need to be successful. It's important that we're able to staff our business the right way, but we don't want our management fee to turn into a profit center, and that's been extremely well received. I think the performance fee end of the equation tends to not get as much focus for us because I think people are generally willing to pay you for good performance, but it's the management fee issue that I think is out there and will continue to be in the way of hedge funds.
Fantastic. The final question that we had on our agenda up here, and then we can turn it over to questions from the audience, is talking about activism. It's something that we've touched on in passing over the course of the last 40 minutes, but I just want to put it up kind of front and center for our two panelists. Vikas, you've touched on this before, but activism as a key recurring part of the CalPERS investment strategy, how important is it, and how do you think that role, that position in the overall portfolio is going to change over the next decade? What's your thoughts looking forward on CalPERS' commitment to activism?
CalPERS is very committed to activism, and we do it internally because we have such a big footprint already in equities. By virtue of having a global FTSE all-world benchmark, you end up owning pretty much every stock on the planet. And we have $2 billion of exposure to Apple, right? So we have a very activist mandate, and it really focuses around governance issues. That's led by Ann Simpson, who was previously at the World Bank doing the same thing. And then to the extent where we can invest in managers We also have an external sort of manager mandate where we invest in activism. I mean, that being said, we structure a lot of those deals on a relative basis. So we're happy to pay performance fees on activist managers, but we're going to ask for performance, usually performance fees levied on a deal-by-deal basis, more akin to sort of private equity on a deal-by-deal basis, and also over a benchmark, a relative benchmark, which might be, S&P Consumer Discretionary or S&P Tech, whatever it is. And we found that the managers, the dozen or so activist funds that we have investments with, have been all right with that philosophy.
And obviously Legion is making a great name for itself in activism. What's your long-term view on how this trend in activism is going to continue?
Yeah, sure. So I think there's a lot of activist activity that's going on in the world, and I would really break it down, though, into two separate categories. There are activist funds who that's what they do. They wake up in the morning, they look for situations where they can go buy up stock in a company, exert their influence, and make something happen. There's another group of folks, and I get a report every morning of all the activist activity that's going on in the marketplace. And if you went through that list, what you'd find is there's a lot of passive guys who, whether they're a mutual fund or just a hedge fund, who's been in a position for a long time, and they're really upset about the undervaluation, and they're trying to figure out what they can do about it, and they become a casual activist, if you will. They're an activist on a single position, but then they'll retreat after that one and probably won't do it again until they run across another one that upsets them. I think that activism absolutely has a place in a public pension portfolio for sure. Back to the comment that these guys are going to be invested in the U.S. equity markets for decades, and making those markets function better is something that should be a focus. I also think it's important to have activist managers at different sizes. So you ought to have a small cap manager, you ought to have a mid cap manager, you ought to have a large cap manager. I know, talking to people out there, and especially if you were to ask the folks from CalSTRS, one of their big frustrations has been it's very difficult to find good small cap activist managers, because what happens is they inevitably, if they're good, attract a lot of assets, and they aren't small cap managers anymore. And so they're always looking for capacity in the small cap space. Activism is going to be around in this country as long as corporate boards are broken, and corporate boards are really broken. If you look at the average compensation today of a S&P 500 director, it's $250,000 a year for showing up at 4 meetings and doing some committee work. It's absolutely too high, in my view. And then when you really break down into who these people are, they're friends of the CEO, people that he's known for a long time. Oftentimes there are a lot of social and other cross ties to the CEO and other board members. People get into these rooms and they're very afraid to voice their true opinion. We've even seen Warren Buffett recently talking about the Coke situation and saying how difficult it was for even Warren Buffett, who you'd think could say just about anything he wanted to anybody, said that he would have difficulty in some boardrooms saying what he really felt. And so I think that's a big problem. As we talked about before, the agendas often don't get set right because you have a combined chairman-CEO role, so it's very difficult from that regard. And then oftentimes we find when we join boards, the board materials are horrible that they give directors. And these materials often come out way too close to the meeting. So you're going to have a meeting, and 2 days before the meeting, they send you the materials. They don't contain any of the answers that you're looking for to answer the tough problems that are in front of the company. And so what we oftentimes spend a lot of time doing is working with the corporate boards to reform the board packages so the directors, hoping that they are showing up, trying to do the best job they possibly can for shareholders, actually have materials to make good decisions from. And that's a key area that we focus on. The problem with the directors just in general, though, is they're way too separated from the ultimate shareholders of these companies. So you think about a guy who's got a retirement account somewhere. That retirement account's invested in some mutual funds. That mutual fund owns 100 securities. that guy who ultimately put up the capital for the investment in that company is so removed from the process of actually doing anything about the governance of that. And then when you get into the mutual fund company, if they own 100 companies, they can't really focus on the voting of these things. So they outsource a lot of their voting to ISS and others because there's too many voting decisions for your average mutual fund manager to make. And so, it really does take some activists who are out there looking out for the best interests of all shareholders to make the system more effective. We spend a lot of time with the companies we invest in, obviously talking about governance, we mentioned that, but really focusing in on strategy, operationally, what's going on, how could the company make more money. What we find is the capital allocation process at many of the companies that we invest in is broken. That's the core problem with the business. They'll oftentimes have a really good part of their business that's making a lot of money, and they'll have another part of their business that's not making very much money or actually losing money. And there's no plan for how that company is going to get that losing segment to be a winner. And the board has been putting up with this for a long time, and there's no clear path forward. And so we're oftentimes talking about how do we stop doing that? How do we push the cash flows somewhere else? All too often, boards are reluctant to give capital back to shareholders because they believe that by giving capital back to shareholders in the form of stock buybacks or dividends, it's admitting that you don't have any good ideas as a director. It's a failure. I would tell you that that's not the case. Giving back money to shareholders is exactly what those shareholders were expecting when they purchased the equity in your company. And so, look, I think boards are becoming more proactive. The governance features are certainly turning in the right direction. I would tell you the one thing that we found to be the case over the last 15 years has been boards are getting a lot more receptive to taking on discussions with us right out of the gates. They're becoming more receptive. And I think that's because a lot of the boards are being advised by Goldman Sachs and others. When we get involved, they'll go hire Goldman on the other side to try and figure out what they ought to do about us. And the advice I think they generally get is pretty good, which is go through the list of things that the activist is asking for and try and figure out which ones you can do that'll make your stock price go up, that are the least painful for you as a business owner. And if you do that, the value, and your valuation goes up, the activists are generally pretty valuation conscious, and they will sell your stock and move on to the next most undervalued company. I think the place where boards and management teams get really sideways with us is when they bury their heads in the sand and try and do nothing. That's really not a very good approach. That's an approach to not being on the board and not being part of that management team for very long.
Vikas, thoughts?
Just in terms of looking at the small cap space, like how often do you run into issues where you have single owner concentration? So how easier? Can you just comment on that? Because I imagine with a lot of small cap companies used to do this in the emerging market space, and our problem used to be is you go into India and companies 70% owned by one guy. So how effective can you be? Right? Do you run into that problem in the U.S.?
Yeah, sure. So there's two areas where we run into problems in that regard. One, if the insiders themselves own, let's call it more than about 25% of the stock, it becomes hard when you start looking at the math for how you could actually win an election if it got to a contested election. So I think that's definitely one of them. The other thing that we see once in a while, and it's interesting, there's been some studies done on it, is an AB share structure. So you'll have the insider groups that economically own, call it 10% or less of the outstanding economics of the business, but they control the lion's share of the votes because their votes vote 10 to 1 on the votes that I can buy in the open market. That's a big problem, and it's such a big problem that oftentimes we just don't get involved with AB share structures. It's almost as though the insiders owned 50% of the outstanding stock, and there wasn't that voting structure in place. So we look out for those. And what's interesting about it, and we've tried to interact with management teams a couple of times on the AB share structure, there's been studies done. Your stock will trade at a discount for having an AB share structure. But people are so worked up over the fact that they might get tossed out of their company that they want to have that structure in place. But whether it's one turn on the valuation lower or 2 turns lower, there is an absolute impact to your shareholders from that structure. But it's one that we can't really circumvent.
There's a number of California-based companies that have AB structures that are some of the largest companies in the U.S.
Yep.
So can you comment on that trend? I mean, is that something that entrepreneurs just prefer these days when they're thinking about IPOing?
Yeah, I mean, I think you see it as a holdover. Some of the companies you mentioned, there have been some startup companies, very successful technology-based companies that have that structure. And it's just, sort of been maintained. I don't think that folks are very happy about it at all. And I think there's growing pressure on firms to get away from having an AB share structure. We're a member of the Council of Institutional Investors, and that council is represented by a number of public pension funds. There's trillions of dollars of assets under management. The elimination of AB share structures is one of their talking points as being a primary goal of that firm right now, is to go and try and interact with companies and show them how their valuation is being impacted and show them how their shareholders aren't getting as fair a deal as they could be getting because of that structure, and having a conversation with them about eliminating it. But it's hard to get done.
Just conscious of the time and wanting to leave a few minutes from questions from the floor, just want to leave give each of you a chance, Chris and Vikas, for a closing question. Let's start with Chris. Closing thought, final thought, words for the day.
Just really excited to be here in Southern California as a new fund, and having gone through the process. California is a great state for having a fund. As I mentioned before, the lack of the groupthink is one thing, but also having really strong partners like CalPERS and CalSTRS, who are very focused on funds in the state, California employment, and those partnerships are just really amazing.
Vikas?
Yeah, I mean, for me, I made the move to California about a year and a half ago from the buy side, having worked at a hedge fund, at a bank, and I mean, it's been a totally different world working and living inside of a pension and living in Sacramento, and just understanding sort of the bigger issues, right? The environmental issues, the social issues, California state worker issues, and what our work ultimately on the investment side is helping to do. So it's been an extremely fulfilling time. Now, with every organization, there's lots of politics, and CalPER is always in the press for that. But I'd say, it is really a tremendous opportunity to work with very sophisticated GPs to help them get started in their businesses early, and really help back them. And I think that's an important role. To the extent that we can do that for California-based firms, not only do we help support the local economy and drive tax revenue, but we really, create a platform for creating more jobs in California, and that's very rewarding.
Great notes to end our prepared remarks on. Throwing it out to the audience. Any questions for our two panelists? Right there.
I don't want to ask too.
Just name and who you're with, and as loudly as you can.
Sorry, Zach Paul. I'm an emerging manager. The potential name, AM Capital Advisors. The model's beta neutral. Smart beta. I just want to touch on a couple things you said, Chris, and I don't want to, take too much time, but I come from a prop model. I moved from New York City back to Los Angeles for, being your family, and I didn't know much about the hedge fund world, and started the process in December, and right now, where I am is the track record part. I just kind of want to get your thoughts, or maybe anyone else's thoughts in here. Is it impossible for me to get my track record from Goldman, or is it something that's possible? Because I'm not, for a week and a half, I haven't been hearing.
Yeah, I mean, I think it sort of depends on how the track record was generated historically. Were you part of a team, and the track record came from a team?
It was an individual property account, but the statements were Goldman.
Okay. Yeah, I mean, I would certainly urge you to try and get those statements and try and figure out what your performance looks like. There's lots of firms that can help you do a GIPS compliance review as well to make sure that the track record is not only calculated accurately, but is up to the GIPS standards. And it's actually amazing how many GIPS standards there are. It's a whole long book on this, how you calculate track records. But the track record point is really important. I mean, I think it's nearly impossible if you don't have a track record to point to get something seeded and off the ground and going.
Other questions? I thought right there.
just want to make a general comment. I'm Jack Paul. I think this has been a marvelous conference. I think you give us lots of insights. I'm just an individual investor. One comment, Vikas, in terms of social good. Years ago, I made a call to my broker. I want you to buy Motorola. He mischarged it. He said M.O. Philip
Morris, yep.
And what happened to me was I lost on Motorola. I said, void it. And that's part of your problem in terms of how you're investing.
Sure.
Because you got these issues of social issues.
Thank you.
Question right over there.
Yeah, I've already introduced myself. I'm Mon Anatoly at UCLA, and I have this question for Chris. As activism has started to flourish, and I've heard it described as shareholder spring, I think boards have gotten a little bit more defensive. Most recently, with Sotheby's putting in and implementing what some people have called an activist pill, a low threshold pill, below the threshold for the poison pill. Are you experiencing management getting smart and putting up some additional defenses to deal with people like yourself?
I think from time to time, we've certainly seen certain companies try and put up defenses against us. I would tell you, though, that a better, well-informed board would probably not take that route, and rather than defending against us, would invite us into the room and have a discussion with the activists and try and understand how to work together. I think that oftentimes when you look at these companies that are putting in place these defenses, and we were to analyze the share ownership of the people that are sitting on the board making these choices, they're not big holders. We could sum total up all the equity ownership that exists on some of these boards, and it's not big in total. And so having a person come into that room with those directors who collectively don't own much stock and have a discussion about the business seems like a very rational place for people to end up.
Question.
Hi, I'm John Range, attorney and CPA, and I have a philosophical question here. Through activism, and I'd like your comments, are we generating more short-term investment profits for investors by at the same time making things more of a short-term rather than a long-term investment goal for companies, so therefore companies in the long run won't have such good returns?
Yeah, I mean, that point comes up all the time. Companies bring out the short-term point constantly when an activist shows up. I think what's interesting about it from where I sit is I will go to CalSTRS before we interact with any company, and I'll get their holdings on that company today. We'll go back and track and see how long they've been a shareholder of company X that's under consideration. And what we'll often find is they've been invested in this company for decades. And while it may not be very big, they've been an investor. And so when we're approaching the company, it's not Legion Partners who just became a shareholder in your company. No, we're actually representing a shareholder who's been an investor in your company for a long time, suffered through the poor returns that your management team's generated, your 1, 3, 5, 10-year numbers that are well below your peer set and well below all the indices we could put you up against. And yeah, we'd like to have those questions answered about what you're going to do to improve performance, because my limited partner is going to continue to be an investor in your company well into the future. And I think, we just need to hold boards and management teams accountable. I think, are there activists out there who are pushing for short-term things that maybe not benefiting, the long-term benefits of the company in terms of, just sending capital back to shareholders if there really are some good reinvestment ideas at the company? I think that could potentially happen, but I think all too often that's just a defense that doesn't really ring true to me, at least.
Yeah, I would echo those points. I think it's pretty obvious when you see an investor that's pushing for, somebody to act, for a company to act on something that's just, it's going to make a dent maybe in the next quarterly results or the next annual reports, the next 10Q or 10K. But you know, we see this in the financial services business. We saw it coming out of the crisis is people, you know, saying, well, you should sell this business, sell that business. And that's not really long term, because if you need those businesses, those strategic businesses for the long term, you don't want to just sell them, right, in order to meet your net income target. So, I mean, I don't really think of that as activism. I think of activism as creating long-term shareholder value. What are the things that the company could be doing, right, that are going to set this company up to be competitive for the next 10 years, the next 20 years, right? I mean, sort of principally good things, right, from a governance perspective that they should have, whether it's accounting or board structure.
Thank you.
Yep.
Fantastic. We've come to the end of our allotted time. I want to thank our panelists here. And I also want to thank all of you for staying to the very end. I hope you appreciated the lunch. I hope you gained something from the conference today. I want to recommend, again, the copy of the private fund report that's on the thumb drive that you've received. We are already beginning planning on the 2015 report. It's pretty soon we're going to start thinking more seriously about next year's conference as well. We appreciate any inputs, any thoughts you have on areas we should be concentrating in. We're very optimistic that our efforts here will be a recurring part of private fund life in Southern California. So I wish you all a very good day, and thank you all for coming.
Good meeting.